Welcome to part 2 of this exploration of how to trade the world's financial markets using what we call the M-33 process. The first few slides will carry on directly from part 1, using illustrations chosen specifically for how clearly they isolate and highlight the individual components in the sequence. But once we've completed that inventory and you begin to spot and highlight these patterns yourself, even in the busy traffic of real-time markets, I think the best way to prepare for your own adventures might be to just tag along with me through a week of normal rough and tumble market activity. The video might get a little choppy, the audio levels might fade in and out a bit, sometimes too loud, sometimes too soft, and my rambling play-by-play commentary will be more like the stop-and-go of unrehearsed thinking out loud, rather than carefully crafted scripts. But I suspect that might actually be the best way to proceed for both of us. So I invite you to eavesdrop on my internal monologue with myself as I think through what's happening in the charts in real time, intraday, each day. If that's all right with you, let's just plunge right in. We'll start by finishing up the more structured explanation of the remaining basic components, and then we'll head off together into the froth of a real trader's daily routine. We're about to sink our teeth into the marrow of what this is all about. We know which quad our chosen country's in. We've identified the best and worst sectors for that quad. So we're now ready to spend the vast majority of our time exploring conditions inside each ticker's range. You will be astonished by the amount of information and guidance available from such a lean and uncluttered image. Just to be sure, though, if you ever do find yourself inside a ticker's range like this, but momentarily feel disoriented or disconnected from the larger context, don't hesitate, not even for a second. Pop out long enough to get your bearings again, and then dive back in. Just for example, let's zoom out from this ultra close-up view out to an 18 months view. From this perspective, we can see how that bear led to a counter-trend bounce near the middle in the summer of 2022, until we got to the nearly horizontal but virulent chop conditions that frustrated so many people that fall and into the first half of 2023. This was the period during which traders who impatiently traded on alerts rather than calmly waiting for the signal painfully lost quite a bit of money as they got seesawed and whiplashed back and forth, or should I say up and down, in the non-trending chop. So let's get back inside our actual range and begin learning the skills that could have saved those poor souls the anguish they felt during the fourth quarter of 2022 and through the first half of 2023. At my ripe old age, I should be pretty blasé about these next steps by now, but I'm not. It's hard not to get a little giddy with excitement when you first realize this stuff actually works. There really is a way to trade sensibly and profitably without chewing your nails to the bone and without enslaving yourself 24 hours a day to the shills of the financial press. Here, finally, is the moment you've been waiting for. When the M-33 signal emerges from her modest reserve and reveals her true nature. We get to witness the real McCoy, a true signal at work, not some nearby alert posing as a signal. Let me draw your attention to the two major crossovers in this panel. And while we're here, note that our ticker is in red and the background noise is in blue. That's purely a matter of personal choice. You'll configure your charts as you prefer. And for example, back in part 1 of this presentation, the default software had the colors opposite to this one. I prefer putting my ticker in red and the background in blue only because I find it easier to see the crossovers that way. Nothing to worry about, just be aware of it and be sure to read the charts as they were intended by whoever posted them. Now, are you ready? Here we are, back at our ticker's price panel again, and all that remains is to expose it to the Oracle herself. Let's place the M-33 signal panel directly below our ticker's price panel. Can you see them? This is what it's all about, folks. Don't worry if it isn't immediately obvious. That's what this presentation is for. Your eyes will adjust in barely a week or two. You'll soon spot the signals effortlessly. Can you see the long red arrow and dotted line running from where the signal crosses over the blue background noise all the way up to the price panel? And how it gets there in time for you to take advantage of the tremendous plunge in the ticker's price that follows? How about the green arrow, which starts where the signal crosses above the blue background noise and runs up to where the price begins to climb again towards the upper edge of the range? I know you'll be tempted to enter trades right away to test all this, and that's fine. Go ahead and feel the itch. But I recommend you hang on just a wee bit longer. At the peak of our probability stack, we'll add some supporting steps that minimize the risk even more. Before getting to that risk management stage, however, let me introduce two members of M-33's supporting cast who complete and enhance the probability mapping process. A little tongue-in-cheek for a bit of pretentious fun, we've given them grandiose names like the tundra hunting analogy and the ratcheting timeframes principle. Beyond the silly names, however, they constitute the essence of the preceding step in our process, the alert. The alert draws our attention to a ticker and warns us to have a look before the signal arrives. We skipped over this alert earlier because it's so much easier to understand once we know the signal will be next. Here is that alert panel. It's a sort of wide-field telescopic lens, one that allows us to look off into the distance at multiple lengths of focus at the same time. What photographers call different depths of field. In this example, our alert panel has been configured to show us what's happening in 9 different time frames simultaneously, from 1 minute to a full week. Starting at the bottom, the longest view is the weekly lens, then the daily, 4-hour, 2-hour, 1-hour, 30-minute, 15-minute, 5-minute, and 1 minute. These are all looking ahead at what's coming toward us across the probability terrain. And a bit like the mystic's idea of a prophetic third eye, we now have the third panel in our precious M-33 intraday layout. And I bet you can guess what we're going to do with it. That's right. Place it right under the other two. And here it is, Home sweet home. This is where I hang out intraday all day long, and from where I do all my trading. It's truly quite wonderful. So clean and uncluttered. We can type in any ticker on our watch lists, and it instantly converts to the corresponding view for that ticker. Are you wondering about the Russell 2000? Enter 3 characters and hit return. How about oil? West Texas crude to be exact. Type in WTI and hit enter again. Let's see, what's everybody whining about this week? Oh, how about AI? NVIDIA perhaps? Type in NVDA and hit return. You instantly have all 3 panels fully up to date for any ticker you care to examine. You only need one more thing before joining in the daily banter with fellow M-33 traders. It's a skill that pulls all the preceding elements from both Part 1 and Part 2 into a single integrated summary. Where the financial press is famous for inventing gibberish-ridden narratives on what they think the markets should do, and then go madly scurrying about looking for data to fit their narrative bias, the M33 community waits as long as necessary for the brutal math of actual fact, and only then renders it into a purely descriptive record that's easier to remember and act upon. We refer to this shorthand as journal speak, an ultra-efficient and unique shorthand that captures what we see in our 3-panel layout for each ticker and reduces it to a sensible, actionable, 2-sentence prose summary on which we can trade with confidence or explain just as clearly why we've decided not to trade at the moment. When a 3-panel M33 layout first pops up on the screen, what do my eyeballs fly to? And what sequence do they follow as they browse for meaningful indications of what that ticker is likely to do next? First of all, a little bit of context for you on this one. I became alert to it back when the ticker was still below the blue background line, slowly nearing the lower edge of the range, but drifting sideways on weakening momentum. Then I actually entered the trade long when the ticker crossed over the blue line, what we call an upward crossover. And a crossover that happened on growing momentum as well. As expected, that's when the price began to climb as shown from the green vertical to the red one. At this point, I've already banked some profit. I sold a few slices on the way up, and the task today, as shown by the red vertical, is to decide whether to take additional profit here at the upper edge, or maybe even close out the position entirely for now. Momentum is weakening, which, combined with being at the upper edge, does suggest taking profit. And this is further reinforced by the alert panel now showing that the 5, 15, 30-minute, 1-hour, and 2-hour lenses have all reversed with downward crosses, making me consider even closing the position entirely for now. Arguing against such a radical step, however, is that the signal in our middle panel, which I tend to leave parked on the 4-hour time frame until it's needed elsewhere, is still well above the blue line. That shows below in the alert panel too, where the 4-hour, daily, and weekly lenses are all still positive. There isn't complete alignment yet, the way we see at times earlier in June when all 9 lenses were green or red. This is what we call full concordance. In this case, I wouldn't close the position entirely due to this lack of full concordance, but instead would only take profit down to my very minimum position of just 1 slice, or even a fraction of 1 slice, until concordance is resolved. And just in case you wonder whether all this chatter amounts to anything, here's a snapshot of a practice day using very tiny position sizes just for illustration purposes. And I assure you this sort of nearly perfect day of all winners is not at all unusual, especially on days of strong trending markets. The same applies to Forex as well. We conclude this phase of our process at the very brink of order entry by capturing all the foregoing ideas from Part 1 and Part 2 into our crisp journal shorthand and our stated destination, in fact. This extract is from my own journal in June of 2022. Reading from left to right, the legend or the notations are: first, the ticker symbol for the instrument, then an arrow showing the overall direction of its trend, the altitude of its price as a percentage distance from the edges of the range, a second arrow showing the local direction within the range. If that arrow is also a cross, it means that the local direction has just begun after an M-33 crossover. Next is a letter M with plus signs or minus signs under it, indicating the local élan or momentum within the range. Then the min, mid, or max, indicating my approximate current position size. Then in brackets, the number of tranches or slices, in my case my max is 5, that are currently open. And lastly, to the right of the colon, what I want to do next. And if I've highlighted it in yellow, it's very, very close. The signal is just moments away, probably. So to illustrate the narrative readback from the journal, let's take the second line, the US dollar or Japanese yen. The first arrow indicates that the trend is up. 50% indicates that the price is currently right smack in the middle of the range. The second arrow indicates that the local direction within the range is down, and in fact there's just been a crossover down. That crossover took place under pretty good momentum. There's an M there with 2 minus signs under it. And it shows my current position size being at my minimum. In this case, it's actually 0. I don't have any position at all yet. And to the right of the colon is my instructions to myself. I'm saying go long on a new upward cross and or around the lower range edge. Do another one. Take the very next one, the British pound, just below that. Its trend is down. Its percentage altitude is 40%, so it's a little closer to the lower edge than the upper. The second arrow indicates that the direction within the range is up, and it has just crossed up on slightly weaker momentum than the previous one, than the yen was doing. I've only got 1 plus sign under the M. I am at my minimum position here again. In this case, it's 0 slices. And my instructions to myself are to short on a new downward crossover and or near the upper range edge. And that makes sense, of course. If the general trend is down and it's currently going up inside the range, it means it's climbing towards its upper edge. And what I want to do is to go short at the upper edge, and especially on a downward cross. Let's do one more. Come right down into the equities down below and you'll see QID. That's an inverse ETF as a way of shorting the NASDAQ. And QID itself is in an upward trend. It's at 90% altitude, meaning it's up very close to its upper range edge. It's also still moving up, and in fact is just recrossed up. The momentum is pretty strong there too, 2 plus signs. And my position currently is at a minimum, in this case, a quarter of a slice, and you can see the little plus sign in front of the quarter. That means long. I use a plus and minus sign to indicate whether it's long or short. And then to the right of the colon, I'm annoyed. I'm saying, damn it, I missed the pullback recently and missed the chance to add to the long position. So that gives you an idea of the internal dialogue that you carry on with yourself as you go through and look at the tickers you have on your watch lists. And eventually, when we get to part 3 of this presentation, we'll be covering how to actually issue orders and take on positions and reduce them and so forth. I've added this slide in case you want to capture a text transcript of the preceding slide to review what the symbols actually mean. In light of what we've accomplished so far, it's time to update the presentation's overall outline to reflect changes occurring as we progress. The alert, signal, and journal sections ended up in part 2, with part 1 now dedicated to the setup alone, and the coming sections detailing entry and exit have now moved to a de facto part 3 that will function more like an appendix, with easily updated caveats, cautions, and commentaries as time and economic conditions affect the markets we want to trade. So once again, I hope I haven't wandered too far from the promised down-to-earth and relatively jargon-free approach to this topic. And I look forward to seeing you in the next few weeks with a completed part 3. Thanks very much, and bye for now.